Hi guys, welcome back to my channel. Today we're going to talk about passive investing and how to choose an ETF as a European investor. Moreover, I will tell you my personal advice for an European investor. My advice is especially directed to Europeans because from a tax perspective it's different from the US and it's easier to buy certain ETFs here in Europe. My suggestion is to invest in ETFs that try to replicate index that cover the entire market so that you're not overexposed over certain markets or countries. You're not trying to beat the stock market or you're trying to predict which stock or sector will outperform the market because that's just gambling. Disclaimer, I'm not a financial advisor and these are just my personal opinions. So when choosing an ETF, it can be a bit confusing because there are many ETFs out there. Therefore, I will try to bring some clarity to you. So let's see 5 things that you should look out for when looking for an ETF. The TRE, or total expense ratio, is basically how much the company that created this fund is spending for the fund. You want this to be as low as possible. To give you a general idea of how much it should be, anything more than 1% is definitely too much, and if you find something that is around 0.1%, that's very good. Depending on the fund, it could be accumulative or distributive. What does that mean? In the accumulative ones, all the dividends and gains gained by the fund are reinvested in the fund. While the distributive one, it gives out the dividends to the people that hold them. Therefore, over time, the accumulative one will grow much more than the distributive one. From a tax perspective, in many countries in Europe, it's much better to have an accumulative one because having dividends every quarter is not very tax efficient. The volume with which they trade is very important. The volume is how much an ETF is traded, therefore buy or sell. And if the volume is very low, it will be very different to sell or buy this ETF. Physical ETF actually holds the stocks in a fund. Synthetic ETF use complex financial tools and derivatives to try to track the same index. Synthetic ETF are much more risky and less transparent. So unless you're really experienced and you know what you're doing, I would advise you to go with the physical ones. Even though these funds are here in Europe and you will buy them in Europe, the base currency could be different. The base currency is a currency which the assets are tracked by the ETF are valued in. The difference between two base currency could expose you to fluctuations in the currency. If the base currency is different from your own currency, the euro, you're more exposed to the currency fluctuations. If the base currency is in euro, you're more protected by the currency risk. When you're more protected, it means you assume less risk, and less risk means less returns. So it's up to you which way you want to go, but I can tell you that over a long period of time the currency fluctuations are really low. All this information can be easily found in the key investor information document. Okay, so now we know what to look for when choosing an ETF. Now let's move on to the portfolio. Generally people allocate their portfolio based on their age. Young people are more risk takers while old people are more risk averse. Old people are closer to retirement so they don't want to risk to lose everything just because there is a crash before their retirement. A good rule of thumb is this one. If you're 30 years old, you will put 30% of your investment money into bonds and 70% into stocks. Stocks are more volatile than bonds, but they will give you a higher return. People that want to risk less will go into bonds because they're safer. The higher the risk you're willing to take, the higher the return. In the past years, and I believe also in the following years, the interest rates from bonds has been really low. With the return from bonds, you barely beat inflation. Personally, I don't suggest an ETF that holds bonds unless you're close to retirement. However, if you want to invest in bonds, I suggest a global ETF that invests in corporate bonds and government bonds. This is called an aggregate bond. Let's move to the portfolio selection now, assuming that you want to invest all your money into the stock market. I suggest a very simple portfolio where you only need to invest in 2 ETFs. So the portfolio is 90% into the global market and 10% into the emerging market. This way, you are following the global trend while being exposed to emerging markets like China and Brazil. This portfolio selection is the most popular among beginners, and it's the one I suggest to you. It's really simple to follow every month. You're probably asking yourself, but Stefano, there are so many options out there. Which one should I choose? How can I read an ETF? Okay, so let's learn how to read an ETF now. So my personal choice for the global and emerging markets are these ones. So the iShare Core MSCI World UCITS ETF. Okay, so iShare is just the name of the company, and it's the most popular one, I would say. Then Core is just like it's part of their core selection, and it's really important. MSCI World is the global index they're trying to replicate. UCITS stands for Undertakings for Collective Investments in Transferable Securities, which is just basically means that meet the European standards and follow the rules of the European framework for ETFs in Europe. The ticker IWDA is the nickname, let's say, of the fund, and it can vary depending on the stock exchange you are on. Then to identify ETF, you will need the ISN, International Securities Identifying Number, which is basically the IBAN or address of the fund. Usually they start with IE, which means Ireland, or LU, which is Luxembourg, because they're tax havens. For the emerging markets, I suggest you the iShare MSCI EM, which stands for Emerging Market, UCITS ETF. Instead of iShares, there are many other funds out there. Another that is very popular is Vanguard. On just ETF, you can search the ETF that is most suited for you. I really hope you liked this video, and if you did, please let me know in the comments. And if you want to see more content like this, please subscribe.